In today's video, I'm going to walk you through a live trade example that happened in the New Zealand dollar versus the US dollar in a 30-minute time frame a few days ago. This is a bit similar to a video I posted the other day when we had to decide which price level we were going to trust based on the evidence of the recent past. If you have been trading for a while, you probably found yourself struggling with this type of market scenario already. Before getting to the line work of this chart, we can observe that raw price action is creating a simple downtrend pattern characterized by lower highs and lower lows. The most important movement here is the price vector from number 2 to number 3, because that is the vector that breaks down low number 1 and renders high number 2 as the axis for the rest of the analysis. I would say that just below in the hierarchy of importance between vectors is the one between number 1 and number 2, and you'll understand why when we get to the line work in a second. This notion of trend that we get from lower highs and lower lows is the simplest and the most effective way of defining trends without having to trust theories that have arbitrary rules, and also without having to trust technical indicators that produce way too much lag. So remember that raw price action data is one of the true leading indicators because the amount of lag in price action is precisely zero. This is one of the many reasons it makes no sense to overlay technical indicators on a price chart. So the idea of adding lag to data that has zero lag makes absolutely no sense in trading, and yet too many people do it. So going back to the analysis, the high number 2 functions as the last significant point in the short-term memory of the market. For those who understand price action analysis, that's the market extreme that will guide the rest of the process. From this point on, there are two questions that arise. The first question is whether or not price will return to a level near number 2. These are questions that are constantly appearing in a trader's mind, and the way we have to answer them is by using different kinds of lines to understand what price is doing. Because even though price action is an excellent source of information for traders, some of this information still remains implicit. Professional line work is what enables the implicit behavior of price to be unveiled. In that sense, we can also say that good line work is the other true leading indicator because it also has absolutely zero lag. By the way, in the price action trading video course I'm producing at the moment, I will focus on these two sources of leading information because they are the only tools we really have to analyze price in the way it should be analyzed. You'll be able to see that raw price analysis and line work go much deeper than what most people think. And that's an incredible skill to have for obvious reasons. So let's understand a little bit about the line work we have in this chart. We have two distinct pitchforks that were drawn using the important vectors from low number 1 to low number 3, because those are the most significant price movements at this point. Nothing else before these two price vectors matter for this analysis. This is a good opportunity for you to realize that you don't need to scroll too far back in the chart to understand what's happening. In fact, that's counterproductive for a few complicated reasons I won't get into right now, but I'll talk about them in the next course for sure. The black fork you see is the most obvious one, and it's grounded on 3 market extremes. The red fork is a little bit more abstract, let's say, because one of its axes is grounded in the midpoint of a price vector. In this particular situation, this combination of forks creates lines with opposing slopes that intersect in a suggestive moment, which is marked in number 4. We also have in this chart a turning point line that comes out of the area around number 2. This is the problem I was alluding to in the beginning of the video. Traders have to choose between different levels where the current dominant player might appear, and it's not so obvious how they should do that. Perhaps the best answer to that question is to really reverse engineer the possible line work and see where the intersections are stronger. For example, in number 4, we have 2 opposing fork lines intersecting exactly at the upper tail of a fractal candle. Given the degree of Brownian motion and apparent chaos there is in price charts, an intersection like that simply has a ridiculously low probability of occurring, and yet it happens quite frequently. So we have a broad price action notion of trend, and the dominant player of this market and we have a precise line work that ties the idea all together. So that begs the question of where we can enter in a sell position, and perhaps most importantly, where we can put a logical stop loss order. For the traders who are brave, which is not necessarily a good thing, the very intersection can be used as an entry with a sell limit order. For the more risk-averse traders, the open of the candle right next to the fractal candle can be used as an entry as well. There are more possibilities in here, but these are the most obvious ones. In terms of the stop loss order, the safest place to put it would be above the high number 2, because for this trade we are depending entirely on the sellers that came out of that high. Some people will try to reduce the size of the stop dramatically by putting it above the high of the fractal candle. But remember that this reduction comes at a price. Sometimes the natural noise of the market will stop you out, even if you are correct about the analysis. So that's what an incorrectly placed stop loss order can do for you. The take profit target is easier. You can simply multiply the stop size by 3, or you can try to optimize with further line work. In this trade, I use the most conservative approach possible, which is the entry at the open of the next candle, the stop above the safe high number 2, and the simple multiplication of the stop size by 3 to determine the target. So let's fast forward to see what happened later. As you can see, the intersection point was indeed a reversal in price, but remember that you cannot simply trade on simple intersections like that. You must have the basic analytical layer provided by the raw price action analysis too. This is a quick example of what the correct type of analysis can do for you. So if you want to learn about these things in detail, check out the 3 courses of the Fractal Flow series in the link available in the video description. If you enjoyed this video and you want to support the channel, please click the like button, subscribe to the channel, activate the notifications so you don't miss future videos, and leave your feedback below in the comment section. Thank you for watching. Take care.